Good afternoon. Welcome to this week's SONAR Market Insights webinar with our house senior market analyst, the Sultan of SONAR, Zach Strickland, and myself, Brad Ganane. Just a few housekeeping things before we get started. We're actually not going to be doing a webinar next Wednesday, as we'll be in Dallas for the FreightWaves 18 conference. Those of you that are attending, can't wait to see you. Having many beginning, intermediate, and advanced sonar training sessions. So we look forward to seeing many of you at those and interacting with you and discussing all things freight and sonar. We're going to stick to the typical 30-minute sonar overview. We've got several new data sets to discuss that we've added this week, as well as a brief market overview as we head into our week buy, if you will. But with that, and then of course we will end with Q&A, 10 to 15 minutes if we have any questions. But with that, I'll let Zach introduce our first new data set, which has to do with rail carloads. Zachary.
Thank you, Brad. So this week we kind of teased this last week, the rail carload volume stuff organized by commodity and also country of origin. So if you go in, and the easiest way to kind of look at this is to go into your search feature, the newly organized search feature, I should point out, as we have divided up agriculture and energy into price and volume measures, as well as created an auto category. So the auto category now has the used truck price indexes in there, as well as automotive production, and more to come on that as we build that category out. But it was decided that, we were trying to keep these categories a little bit more contained, but it just, we need something that will allow the user to quickly identify where some of these indexes are, or indices, however you prefer to say it. So we created a few more categories to make it a little bit easier to navigate. Anything having to do with price and volume are now separated out. So the rail categories down here, which consists pretty much of all the new rail indices that we've come up with, and they are carload volume. So what that means is anytime a rail line originates a carload of grain, that's one carload, and it starts out in Missouri going to anywhere in the U.S. So that would be one carload of grain originated in the U.S. If it originates in Canada or Mexico, that will have a different value all to itself. So going through some of these, we kind of teased the eggs last week. No, that was the agriculture. I'm sorry. Yeah, we kind of teased these just in general last week, but I have pulled up rail traffic originated farm products, excluding grain, in the United States of America. So you can see here that we have several years, I believe it's at least 5 years of this data. So you can kind of see these trends and patterns of specific commodities as they've traveled along the rail. A lot of these are correlated with just general commodity flow in general. So if you wanted to look up, any kind of specific commodity that you are interested in hauling, chemicals, for instance, if you're in bulk, you're going to have the option of looking at chemical volumes in the carloads, and you pull out here. We make a big enough chart to make it
and the granularity is the United States, right? On
United States, Mexico, and Canada. So it's North American rail originated freight. Chemicals, you can see, are quite volatile in terms of volume. This is significant in the way that, it's going to be very niche. The people that are interested in this are going to be very specific, commodity driven people. A lot of this stuff also can be derived in greater kind of macroeconomic fashion, as certain commodities do lead industrial production and other industries that have to do with them.
So how could I look at, for example, something like how would rail traffic originated chemicals in the U.S., Mexico, and Canada, how could I look at them separately or together, or how could I use that, I guess?
Like I said, it's going to be a very niche user.
Sure.
These are going to basically give you an option. You may not realize it right now that you're hauling something that's greatly dependent on the chemicals hauled on the rail, the derivatives thereof. For instance, let's see if I can find one that I have had actual personal experience with in here. So, well, coal would be a good one to look at, and sand and gravel. These are used in construction and also oil. So when you see a lot of gravel, sand moving, the oil industry is probably picking up a little bit. You can see here that we've had declining gravel, sand, so construction is probably slowing down a little bit in the economy. Again, the bulk carriers out there that are hauling a lot of this freight, they're interested in knowing, well, is it me, or is it the greater, economy, or specifically is the crushed stone, sand, and gravel commodity just not moving like it was? Are we not getting as much production? And this is a good way of seeing that. A lot of these, I know we've had a lot of inquiries from our bulk carriers, and a lot of these commodities are hauled in bulk. Mm-hmm. So anytime they have a specific commodity that they're hauling in bulk, like, they can go here to see how that specific commodity is doing in general. Because a lot of this goes, like, for instance, if I'm into hauling a lot of dirt and gravel and sand, I can see here back in May, I was having a pretty good time. Mm-hmm. I can guarantee you that I'm going to go and get a load and keep my truck moving, hauling this material. Now I can see that things are kind of slowing down a little bit. A lot of this stuff is going on the rail. The rail might have more capacity, so I might need to look at other commodities to put in my truck.
So for rail traffic originated outside of the U.S., is that going to be delivering with destination point in the U.S. or not necessarily? Not necessarily.
They're basically organized by the rail lines themselves. So wherever they're, they can end up in Canada. They can end up we don't have the endpoint on here. Okay. So it's all origin driven. Perfect. So yeah, so be sure to check that out. Especially, I know a lot of people don't know, man, I don't have anything to do with coal or grain or whatever. Well, it all still interconnects. The grain market itself does have a significant impact on the truckload industry because a lot of these carriers get sucked into the grain belt in the harvest seasons. And the derivatives thereof, like all the grain gets turned into food, eventually. So when you see an excess of grain, that means that if you're dealing with people like General Mills or Kraft or any of these other kind of large Cargill, any of these other large shippers that deal with food products, if you see that they had a huge grain harvest and a lot of grain moving on the rails, you can be dialed in to knowing what that specific industry is doing. So it's not quite as straightforward as a lot of the tender rejections and volume and stuff, as it's like directly impacted. But also just general rail volume is good to kind of look at and see what's happening, especially as the coal declines. The coal movement is actually one of the biggest things that move rails. But as coal production kind of comes offline a little bit, the rail is going to look more for other things to move. The intermodal, for instance, is going to take that place, and it has been taking its place over the last year or so.
Yeah, and it looks like that we do have that down there as well, the intermodal trailers. I think it was just below.
Yep.
Maybe you want to pull that one up to look at really quickly.
The intermodal trailer. Oh yeah, they're up at the top. Intermodal. There it is.
Containers.
Bam. So USA intermodal trailers, which of course quite relevant nowadays. Let's pull it all the way out. You can see that it actually is trending up over the last couple of years. It had its highest point in several years just recently, as we know that because we've had high port volumes over the last little bit, specifically in the West Coast. So yeah, there's your intermodal traffic in the United States.
Looks about right. And then also one other thing that I saw in there that we've had a lot of questions about from a lot of our flatbed companies that we're working with are some of these rail traffic originated. What do we have? The steel and iron and steel scrap, things of that right there. So maybe speak to how this can be viewed as for some of our flatbed carriers who, because of the nature of a lot of those transactions, there's not quite the granularity that some of them would like from an actual load standpoint, but there's a lot of surrounding macroeconomic data, and also things like rail traffic that have a huge impact on their freight flows and their freight volumes. And of course, that kind of being the beginning point of the increase in, or showing the health of the freight market, that kind of being the starting point a lot of times in that flatbed market.
Oh yeah, the flatbed market itself is kind of a leading indicator in terms of, it's at the first point of the industrial production in the economy, because the nature of flatbed is kind of like that first line of production. They don't go to places with docks for the most part. They go to job sites, places without docks, places in open fields, new construction, that type of thing. So you see a lot of these kind of raw materials and products going on flatbed trailers. And so just like with the rail, a lot of this iron and steel will move and give you an indication of just what the general economy is doing. So if you're in flatbed, I mean, yeah, you're probably more interested in some of these raw materials than a lot of these other carriers are. And that's what a lot of this is on the rail, because it hasn't been packaged yet. Flatbed freight typically is not packaged. You have to strap it down in its rawest form. A lot of these steel bars and pipes and stuff you'll see rolling across the interstate. That's probably not going to a place with a dock. That's going to new construction where they're laying out something in a field somewhere, because it simply won't fit. So yeah, and we've seen flatbed kind of stabilize over the last several months and then really drop off here in the last month. And we're seeing signs that the overall industrial economy is taking it's still growing. Things are still looking good, but it is not growing quite at a quickest pace as it has been.
Right. And that's something you and I have talked about, though. There's a lot of timing has a lot to do with that as well, being October, November from an industrial standpoint.
Yeah. And so, I mean, if you look here on the iron and steel, I mean, 2016 was a very soft year, and you can see iron and steel fell off. I mean, and again, we knew that the, kind of the industrial side of things in 2016 kind of fell off, and look, this iron and steel production led it. So these flatbed carriers and people like that really have insight into what the overall economy is doing. It's a lot more volatile market, but it's very sensitive to what's going on in the initial phases of, when things are starting to pick up.
Yeah.
On the demand side. And
I think they, from my perspective, and correct me if I'm wrong, I think on the flatbed side, the data is a little more broad, and the conclusions that need to be made are on a little more macro, broad scale than purely just looking at load volumes from maybe a van or reefer carrier, broker, shipper side of things. But certainly the data is in here to be able to accurately plan and prepare for changes in your market, depending on who your customers are, what regions that you're running. But there are things here in Sonar that
oh, absolutely. Even on the, you may not think that there's a relationship between dry van and flatbed, but there absolutely is. Whenever there is an excessive amount of freight in the market, you can guarantee that there's going to be some of that freight moving on a flatbed. It doesn't necessarily have to go on a dry van.
Right.
So when there's a lot of volume moving in general, flatbed carriers are going to have opportunities, even when their particular niche, maybe their shipper or particular commodities not doing well. They can certainly look to other areas. They move the same freight that dry van can, as long as the weather's kind of, or they strap on the tarps and whatnot.
Right.
So yeah, it's all interconnected. So they do definitely move together. I think reefer doesn't have as much correlation or anything to do with flatbed, but dry van for sure does.
Yeah. So that's the rail traffic. Again, you can see the granularity there when you pull up the tree chart. We also, did you talk about how we broke out energy to price and volume? I believe that was a change.
Yeah, we did. And while we're on energy, knowing that we split it out, we did add another couple of tickers here. The Brent crude spot price. Go ahead and pull that one up. And I'm not going to give an oil market lesson like I did. I'm not in the oil market situation, but for those of you that are interested in this relationship, we now have the Brent crude spot price, the WTI spot price. That's the West Texas Intermediate. These two are they kind of flip-flop in terms of being international benchmark for crude oil prices. And these are very significant macroeconomic indicators for the overall global economy. So I'll go ahead and give as best of kind of a brief explanation of why these are important to those of you that may not know that. So the relationship between these two, the Brent region is in the North Sea. That's where the oil comes out of, like north of England and London, the British Isles up there. And that rate is typically considered kind of the international benchmark for oil price. So when the WTI rate goes below the Brent, which it has been for quite some time, the United States produces that in the West Texas region, in Lubbock and points west in the deserts out there. So when our oil goes below the Brent price, our oil becomes more favorable in the international marketplace. People want to buy it because it's cheaper. Mm-hmm. And the problem is that the pipeline is constrained coming from Cushing, Oklahoma, which is the origination point for most of the oil to get pumped out. And it goes to Houston, where we will ship it out across the world to various markets. So as that pipeline is not really equipped to, handle all this supply of oil, that goes on trucks. Mm-hmm. So the more of those trucks that get needed, I mean, it represents a significant amount of truckload volume, tanker volume. So those are drivers that could be driving dry van that are now driving tankers, and they're getting paid for it. Mm-hmm. So this is a significant thing. But the macroeconomic indication here is that as the spread gets larger, as you can see down here, it's at 10, which is historically high. Our oil becomes even more favorable, which actually creates a lot more purchasing of the oil, and it boosts our economy here in America, which means there's going to be more jobs, more money flowing through the economy. You're going to have more freight coming into all other spaces. Mm-hmm. So just in general, having that number be as high as it is right now is it's a good thing for United States, the economy in general. These prices have been moving down over the last couple of weeks, however. So another thing to kind of monitor is once the price of crude gets too low, we'll shut off the refineries because it no longer makes sense to produce the oil itself, which is very bad. That's something that happened in 2016 when things kind of slowed down for a little while. The price of oil kind of dropped off, and it created that people started shutting down because it didn't make any sense. They weren't getting paid enough to do the work, right, essentially. So it's certainly a very important thing, and I think a lot of people don't really understand it. And I sure don't understand it as much as some people do. There's people that sit in rooms and watch this stuff all day. So they trade futures on it and the spreads and everything like that. So it's quite an interesting space. But in terms of trucking, it actually is a pretty good thing to watch and keep in mind. As this spread gets higher, typically that's good for the economy, good for trucking. As it gets lower and the price kind of, if it ever swaps, that's not great for us because people start buying the Brent oil, which is not us. So that's it in a nutshell.
That's very good.
Yeah.
And so that's how we added that, and that's been broken out as well in the energy sector.
Yes.
And you found that under volume, I believe, price.
Yeah. These are all under price.
We also have the volume broken out. They're in two different categories. Same thing with the agriculture, which we probably don't need to go as much.
Yeah, we have crude oil production in the lower 48, Alaska and USA, which would be Alaska plus the lower 48. For those of you that are interested in the crude oil production, this is in barrels. You see, we're producing a lot more oil than we have been. We actually took over we're the largest producer you see right here, 2016, they stopped producing because the price went too low. And then it went back up. And that's kind of what has stimulated the economy to this point, is this kind of industrial activity. Also, the tax cuts didn't hurt. Right. People are buying up trucks and stuff.
So can you connect a few dots and a few lines to clearly we're kind of dancing around it with oil, crude oil production, actual freight volumes, and the overall health of the economy, I guess. Can you kind of put them all together and discuss how they're all tied and how they drive each other?
Yeah, I mean, I'll do my best. The bottom line is, the price of oil, people tend to get upset when the price of gas goes up. That's actually a really good indication that things are that are going well, because that since we're being the largest producer of oil in the world, all that money just goes right back to us. Right. So when we have, it's like you have to think about it in terms of like most cities like tourism, and it's because it brings money into their specific area. That money doesn't necessarily leave the area. A lot of it gets left in the area so people can open up businesses. Banks have more money to lend to, people can go open up cupcake shops if they want to. As the money kind of aggregates in the area, it just promotes a better economy and growth. So when people are buying our oil, that money comes into the United States. We now have more money for investment. The capital investment over the last year has been insane. People have so much money laying around. They're looking for anything to buy. And this investment creates, this glut of money that people then can go out and purchase new trucks. They can give people wage increases, which they've just started doing with significance. As people have more money, there's more jobs, there's more freight to move, more production. When people want to go out, housing starts, for instance, is one that everybody kind of understands the most. People have more money to buy houses. People will start building more houses. That's wood, the furniture that goes in it and whatnot. These are all things in it. They're all tied together. Connecting the dots is kind of a complicated line of thought that you have to that follow. But the bottom line is, when we're producing something in America and the world is spending money on us, that money is staying within our country. That's good for our economy.
Absolutely.
Yeah.
So if you're take us back 2, 3, 5 years ago as a market analyst, financial analyst for a transportation company, is this something that you're monitoring closely on the side?
I was a financial analyst a couple of years ago for a transportation company. So I actually did use the DOE price of fuel to kind of pay attention to what the economy was kind of telling me, because those two things are interrelated as well. This crude oil production value, however, would have been a lot faster than the DOE rate. And I would have been able to kind of glean from this and various other macroeconomic indicators that, hey,
times are still good.
You know what? Because a lot of the, I dealt in a company that dealt with shipper side and carrier side quite a bit. So we were somewhat in the middle. We're kind of unique. So the shippers would always tell us, hey, we're doing great. We're having a record year. Right. And we would just say, well, we're not getting volume from you. and you told us we were going to get 10 truckloads a day of, this freight, and you're giving us 2. Right. And they were like, yeah, man, it's just because your service not good. And so we would just be like, well, the service is the same as it was last year, and you're still not giving us this freight. And it's like, yeah, we need something better. And so we'd go back and we'd kind of talk amongst ourselves and be like, beat up the operation, tell them, hey guys, you need to get better service, yada, yada, yada. And then, on the other side, our purchase transportation, the carriers would say, oh man, we don't have any capacity for you, man. We're just out. In the meantime, they're turning down our freight because they locked us into a contract rate that was too low for them to go and haul fruits and vegetables off the West Coast. So having this information at your hand, like if you know that the economy is doing well, you can pretty much glean that shippers, for instance, are doing well. If they're not doing well and they're publicly traded, you'll figure that out real fast on an earnings call. But For the most part, you're trying to figure out what is the general market doing. That way I know, hey, I know you're not doing that great. I don't have to go beat up my operation. My service is fine. I'm going to give you a rate increase anyway because you don't have any freight, et cetera. And that's how you kind of use that to kind of leverage yourself.
Sounds about right.
Yeah.
So we're running close here on time. Maybe give us. Well, I know Southern California is going a little bananas.
What do we got here? We got like 5 minutes. Let's do the market in 5 minutes.
Let's do the market in 5 minutes. Is that a new section that we're at?
Every week, Brad and Zach will give you the market in 5 minutes.
So what are our most interesting
I'm going to go ahead and
regions?
I'm going to start at a high level and work my way down.
Start me up top.
Start you up top. And anybody can get on FreightWaves.com and read some of this. But go ahead and change it to one of my favorite charts to look at, the baseline OTVI. For the United States of America. And you can see after our big drop in volume at the beginning of the month of October, we have since recovered about halfway to where we were back at the end of September and have stayed there. So that's telling me that the market itself is not fully recovered. We are still in a low volume situation. For those of you that have seen the OTVI, this 97.11 value indicates that we were roughly 2.89% lower than we were on March 1st of this year, which is when we created this, or the base time period for creating this index. So that in itself makes me think that the outbound tender rejection index levels in America are probably going to be flat as well. And what do you know? They are. They have flattened out after showing signs that they might be turning up at the end of October. They have decided to kind of level out here as the majority of the country has not really seen the same amount of heating. We'll go into as I try to do this and talk. So you can see we've recovered quite a bit from June high levels of 25, 26%. Tender rejection, we are now sitting down here at almost 13%. So half of what we were. The market is extraordinarily stable right now. Shippers should be pretty happy with their capacity situation, except for the West Coast.
Right.
So if we go out west and look at our favorite market, Los Angeles, you can see that this thing is shooting way up, way fast. Los Angeles, Southern California market in general, over the last several days has shot up, I believe, 300 basis points, almost 3 percentage points, 3 to 4. And then you go to markets like San Diego, for instance, and you see something very similar. Southern California is pretty much the only market in the country that is showing this level of destabilization. Now, the thing to note about Southern California, this happens just about every year in November. A lot of the port volume kind of comes in, and it gets pushed out off the coast going to DCs and warehouses for retail and all that kind of stuff. But also, a lot of it has service requirements and things like that create a little bit more panic because they don't have as much time to get this freight out because they know that they need to make it there by Thanksgiving and the holidays. Other things to note is that this year doesn't look like it's going to be as extreme as years past. Last year's kind of capacity crunch started off with the hurricanes. We had hurricanes, but they did not hit with as much significance. That doesn't appear to be crunching the country as much. Places like Dallas and Texas, Texas in general, some people may not know that we actually have outbound tender rejection index by state. Texas is starting to shoot up a little bit, but it's still not high. It's historically low. It's been on a downward trend, but that's kind of the next place that I'd be keeping an eye on. Even though it's down right now, the next stop for that LA freight is Dallas, Atlanta, Chicago, in terms of your more dense lanes. Of course, there's also Phoenix, which is the biggest lane out of Los Angeles, but that's kind of a intra-region. I tend to like to look at the over the road stuff to get a bigger picture. So this turning up, I'm keeping an eye on Dallas as that's the next step. Every produce season, that's the market that it goes to first. As capacity goes out west, because they're going to make a lot of money on those loads coming off the coast. So the East Coast is quiet. The West Coast is hot. Volumes are still relatively low.
And I think
Mhm.
checking, to your point, your big intermodal hubs across the country. Once we see these very large volumes hit the West Coast ports, to your point, the Joliet markets, Chicago, those big intermodal areas that are going to feel this kind of lag volume that comes across, which it doesn't look like they're quite seeing it yet, but comes across from the West Coast. And
that's why it's kind of like important to look. I'm going to show one more chart before we kind of turn it off. Laxdal. Something that I've noticed is, and you can see I've got a big old mess on it right now. Go ahead and pull back on this. And you can see, I'm going to pull back quite a bit, actually, if it'll let me. I want to see this intraday movement. So right here, you can see these rate swings bouncing up and down. I'm going to change this to a line. It makes it a little bit easier to see. These rates are jumping up and down 15, 20% in a day. This time last year, no, we were following this really smooth kind of upward trend. This year, the market is completely confused.
mm-hmm.
They have no idea what's going on. There's some spikes in volume out in LA that are creating this, idea that, the market's turning like it does every year. But wait a minute. No, maybe it's not.
No, then there's no volume.
Yeah. So the market right now is as volatile and confused as I think I've ever seen it. Everybody's waiting on the big turn, the big push. And it just hasn't really happened except for in places like Los Angeles, which is probably driving a lot of this.
Yeah, that's a really interesting thing to look at is that, really rates not changing too much, but that volatility is really interesting.
The volatility there is nuts.
Yeah, if I had to guess, it's probably, as we talk, very much the anecdotal information of saying,
everybody heard there's no freight out west, so it's the market's turning now because I'm coming out with freight every day,
right?
But nothing's coming back, so the rate's coming back down.
Yeah, exactly.
So that's why it's important to have your tender rejection indices and
tender volumes
and all that, so you can tell exactly what's going on in the contract side of things, not just the spot market, because
that's one thing to note. I'm sure a lot of people here are SONAR subscribers, so they know that, but that this DAT van rate is, we're looking at the spot market, and more importantly the actual rates, whereas the SONAR data is contract driven.
So there is some transactional freight in there, but most of it is, the gross majority of it is definitely contract driven. And that is the bulk of the freight. The spot market is, you have to think about it like a glass that gets overfilled. The spot market tends to get all the stuff that falls to the side, whereas the glass is holding the most of the volume. And that's what the contract is the glass with the water in it.
We're about out of time here, and we'll stay open here for a few more questions. I like how you threw a little SONAR plug in there. That was really nice.
Yeah, I'm not a salesperson.
But we look forward to seeing many of you next week in Dallas at FreightWaves. Those of you still interested, contact us at sales@freightwaves.com, or those of you new to the webinar that would like more information can also contact us, sales@freightwaves.com. Again, we will not be here next week
or the following week, because it's Thanksgiving.
Oh, it's Thanksgiving. Maybe we'll do something special though. I don't know, like a turkey webinar. I'm throwing that out
there. You're making some promises.
I may not be able to keep. But yeah, so stay tuned for some communication on when this next webinar will be taking place. We'll stay live here for a few more minutes to see any questions. I believe we actually do have one regarding granularity of flatbed indices. We're currently still working with providing that at a more granular level, so stay tuned. Don't have an exact date on that. Have a few other things as far as the roadmap of SONAR that are at the top of the list, unfortunately, but that is definitely there and will be available at some point. So stay tuned on that, and we'll, again, thank you for joining us, and we'll be here for a few more minutes if you have any further questions.
Cool.
All right, we're going to go ahead and get out of here. Looks like we don't have any further questions. Thanks again for joining us. See you guys in a couple weeks, and most of you at MarketWaves. Thanks, guys.
See ya.